Welcome to the Option Pit webinar, Trading Direction, Using Volatility to Improve Directional Trading. For those of you that don't know who I am, my name is Mark Sebastian, and I want to remind you that this is for educational purposes only. None of this is considered investment advice. Options do have some risk. Consult your financial professional. I was a trader on the CBOE and the American Stock Exchange, the Amex, for about 10 years. After that, I started Option Pit and a hedge fund. So I run a hedge fund called Carmen Line Capital. It is a volatility trading hedge fund. And then I also am the founder of this company. We are an education and consulting company. We work with kind of traders at all levels, from beginners out to doing hedge fund consulting. In fact, one of the reasons why I started a fund was I got so sick of helping other people make money in their funds. I said, well, why aren't I doing this myself? And it's nice to be trading for, really in it again after a couple of years off. I like to joke that we've got clients that have $15,000. We've got clients that have $1,500, and we have clients that have $15 billion. We cover everything. All right. Chris Bryant just hit a home run. So let's talk about directional trading. Volatility can act like a headwind or a tailwind to successful trading. It's very much like flying or boating, right? Flying into when I fly from Chicago to New York, it takes me about an hour and 40 minutes. When I fly back, it takes me about 2 hours and 15 minutes. Why? Well, because on my way back to Chicago, there's big headwind. On my way to New York, I've got a tailwind. That's because of the jet stream. Volatility is a lot like the jet stream. So what we're going to discover is basic buy-sell decisions. When to buy options, when to sell options. We're going to talk about how strike selection makes a big difference. And then I'm going to teach you a couple of combinations of buying and selling and strike decisions that can really pay off. So I'm going to teach you a couple trades I use. All right, so delta. Delta is the option trader term for correlation. In math, it can also be called slope. Delta can change with the passage of time, change in price, or change because of one important factor. All right. The delta is essentially how much money an option makes if the underlying rallies or if the underlying falls. So if I have a positive 0.6 delta and in Apple, and Apple goes up $1, I will make 60 cents. If I have a positive 0.6 delta and Apple goes down $1, I will lose 60 cents. All right, now, what if I have a negative 0.6 delta? If I have a negative 0.6 delta and Apple moves up $1, I will lose 60 cents. And if it falls, negative times a negative, I'll make 60 cents. That's really what delta is. But what's the problem with delta is that it can change on a trader. All right? It can be pretty easy to understand that price movement and passage of time change delta, right? I mean, if I buy, Apple's trading $150. If I buy a $150 call, what do you suppose the delta of that $150 call is going to be? Deltas can go from 0 to 1. What do you think it'll be? What do you think? It'll be 0.5. All right, so now I've got this 50 delta option, this 0.5 delta option. All right, and then and then Apple goes from 150 to 170. Do you think that that Apple option is still a 50 delta, a 0.5 delta, even though it's now $20 in the money? Or do you think its correlation to the underlying has changed? Yeah, its underlying correlation changed. All right? And that's really the key. All right? So, while there are ones that are easy, passage of time, things like that, the one that really has the greatest effect on delta is, and how it performs in a trade, is volatility. Okay? So I could dig into all of the different things that affect delta, but we're going to concentrate on volatility. So this is how kind of a call option will move with the underlying. All right, the underlying goes up. The call option starts to correlate, and the higher it goes, the more and more it correlates till it's got a delta of 1. All right, this is how that price action changes, how the P&L changes. So this is one I get a lot. Mark, I bought these calls right before earnings. The stock is way higher, but I'm not making money. Market makers stole my money. All right, and the answer is no one is taking your money. One of the inputs into delta changed. So let's look at a trade. Let's look at Lowe's. All right. Lowe's didn't have such a great day today, did they? All right. So let's pull up what this looked like yesterday. All right, so here we are yesterday. Lowe's was 82.35. And the 78.5 puts, or we'll just use the 78 puts that expire on Friday, were about 47 cents. All right, the ones that expire in June, let's call them the 78s. We'll call those 75 cents. Well, let's see where those settled today. Stock was down $2.50. How much was my May 78 puts worth? Wait, the stock was down, right? I have a delta on these 78 puts of 0.2165. With the stock down $2.50, I should have made 50 cents. Should have made 50 cents. My May 26s, those 78 puts, they have a 15 delta. I should have made 32 cents, 37 cents, excuse me. And my Mays lost money, a lot of money, and my Junes, June 78s, they lost money too. Well, what happened? Well, I want to show you a chart. This is called, this red line is implied volatility. This is one of those things that can change on a trader and affects delta. Well, look what happened to implied volatility. It went from 27 to 18. Implied volatility tanked. That changed the trade. All right. So the Greeks, like delta, are modeled risk. They're based on models. They're meant to help traders manage the risks of a given option position. All right. But one common mistake, Greeks are not a hard number. They're not set in stone. All right. They're based on modeling. Anybody ever heard of modeling that failed? There are a lot of areas where modeling failed. So since delta can change on the trader and is modeled risk, picking the right option for the directional opinion is the key. Should an option be bought or sold? Should it be at the money, in the money, or out of the money? It all depends on implied volatility. So what makes trading a stock different than trading volatility? And the answer is, over the long term, we know where implied volatility is going to go. We don't know where a stock is going to go. So here's two images. This is Apple. Does that look like it has a mean? Does it look like it has an average? Maybe in very short spurts it does. But really, over the life of this stock, does it have any average? No. Now, this next chart is called VXAPL and is the VIX, so it's the volatility index for Apple options. All right. I mean, this gray line is the 200-day moving average. That's about as pancakey flat as I've ever seen. The red line is the 50-day moving average. Even that's pancakey flat. There is a mean. So a stock can go anywhere and stay there. Volatility can go anywhere, but it won't stay there. It will fall back. Saw that last week in the quote-unquote VIX. VIX went from 10 to 15 to back to 10 in a week. So understanding this will help you with buy and sell decisions in options. Basic buy-sell decisions. In general, when implied volatility is low in the near term, and especially in the long term, all right, it makes sense to buy options instead of sell. So right now, the VIX, the broad market volatility index, is really low. So then if you have that really low and you have the equity that you're looking at's volatility super, super low, it's very difficult to want to sell anything. So if you have a directional opinion, it may make sense to buy an option. So when IV is high or normal, though, normal, meaning the long-term mean, typically makes more sense to sell. So one wants to get long the underlying, long exposure to the underlying. One can sell puts or buy calls. Each trade acts very different despite being long the underlying. So let's talk about short puts. A short put is a long delta and is also short volatility exposure, or Vega. So if I'm short Vega, that means I want volatility to decrease. Thus, I'm hoping the stock moves higher and implied volatility comes in. What makes IV drop? What makes implied volatility drop? Implied volatility drops because movement drops most of the time or after an event. So this is the way I like you to think about short puts. When you short a put or a credit spread, a put credit spread, you're making a play on lower realized volatility. When you're selling a put or a put credit spread, you're not betting the underlying is going to rally. You're betting that it won't go down, which is a huge difference. Here's an example. Take a look at ExxonMobil. It's had two separate occasions where implied volatility got pretty expensive. without an event around it. And in both these cases, it made a lot more sense. I mean, it's not like the underlying made a huge move higher. It went from 80 to 81.5. In this case, it went from 81.5 to 82 on this vol spike. Implied volatility fell dramatically here. All right. So if I pull up a chart of ExxonMobil, pull up ExxonMobil here. Let's take a second. All right. Let's look at ExxonMobil. All right. So let's just look at this most recent vol spike. Here we are on Wednesday, May 17th. Low is actually the 18th, but we'll do the 17th. All right, so let's look at the 17th. In June, I could do two things, right? We'll use June 9 so that I have dollar strikes. So in June, I could do two things, right? I could buy a June 9 182 call, or I could sell a June 9 182 put. All right, so I collect 120 if I sell put, and I pay 130 if I have a call. Well, as you can see, over the next couple of days, the stock does rally all the way to 82.58. So which made more money? My put sale at 120 or my call purchase for 130? Well, my calls are worth exactly the same amount, despite the stock being higher. My puts are worth 50 cents less. What would you rather do? Make nothing or make 50 cents? What do you think? Would you rather do nothing, make nothing, or make 50 cents? This should be a pretty easy answer. If you don't know the answer to this, you should probably be doing something else besides trading options. That would be my interpretation. Correct. You'd rather make 50 cents. Congratulations. All right. So that's why when volatility is high, it makes a lot more sense to sell put spreads than it does to buy calls. Now, what about when volatility is low? So the difference between that, a long call and a short put, a long call is long delta and long exposure to volatility or vega. So when I trade a long call, I'm actually making a bet that the underlying is going to rally. Right? I'm making a bet the underlying is going to rally. So in making a bet the underlying rally, what am I looking for? I'm looking for volatility to go up. So what makes that happen? Increases in movement or increases in expected movement. Those are the keys. right? It makes a big difference. It really does. All right. So I'm looking for an increase in expected movement. I'm betting the stock's going to go up. Here's Alta. So what you point toward is consistently low implied volatility that starts to slowly pick up. And then what I want to point you toward is as it's picking up, volatility is still super low. I think the underlying is going to rally. I buy a call. I kill it. I mean, Alta has been the easiest long call purchase in the history of mankind over the last 2 years. Now let's cover getting short. Like going long when one is making buy-sell decisions, when IV is high, you sell call spreads. When IV is low, you buy puts. Macy's. Nice little IV pop. It ain't going higher. Sell a call spread. Sell calls. Underlying can't rally. Volatility tanks. They make a lot of money. All right? That's a great trade. Let me show you. Here's 17th. June. I sell a, stocks trading 23. I sell a, I don't know, we'll do a 24-27 call spread. And I collect 45 cents. All right, here we are today, in June. Stock's higher. How's my 24, 27 call spread? Well, it's at 36. It's 36. 35 cents. So I made money and the stock's higher. Now here's IBM. Volatility's in the toilet after a bad earnings. Bad earnings, IBM keeps going lower. You buy puts. Did the same thing recently. IBM's like clockwork. When they miss on earnings, they crush vol, then I buy puts. Take a look at the chart of this thing. I mean, if you bought puts right after earnings, you know, let's say you bought some June 1, here we are, June 1, 60 puts. 350. 360. Well, how do those look now? You got a big move. Stock dropped. Today, even with time passing, those June puts and volatility dropping a little bit. Those June 160s are worth 750. I'll take 100%. All right, now let's talk about strike selection. The next step is the right strike. This is done based on the certainty of the next vol move. So when one thinks that IV is absolutely, if implied volatility is absolutely going to go up, you buy what's called a soft delta. And a soft delta is basically an out-of-the-money option. One believes IV is going to be stable. You trade a hard delta. Hard delta. Hard delta is relatively resistant to change. Hard deltas are in the money and at the money. Soft delta. A soft delta is dependent on changes in volatility for out of the money and far out of the money options. So when would I want to buy a hard delta or sell a hard delta? Not sure the IV movement. When IV is very high or very low, at its extremes really, and when one isn't sure of the next move but wants to have limited risk. So here's Goldman. This is an old one, but it works really well. Here's Goldman. Look at that vol. I think it's going to rally. It's overdone. So I can buy one of the 110 calls for $750, or I can buy a bunch of the 125 calls for $96. Look at those IVs, 29.64, 26.5. Well, here we are a week later. IV dropped, IV dropped. I made money, but how much? Well, if I bought one 110 call for $760, I was technically getting long 70 deltas, spending $760. Or I could have bought 8 for the same amount of money, could have bought 8 of the 125 calls. Getting long 130 deltas, spending $768. A week later, my 110 calls are worth $1065, $305 on a one lot, almost 50%. My 8 Goldman Sachs 125 calls, I make $1.84 profit on all of them. I made $184. So I spent more and made less. All right, now soft deltas are more sensitive to changes in IV. So when do I buy them? When IV is really low, like right now, when I'm looking for a major move and I want a cheap bet. Here's IBM. I think there's going to be a short reprieve in the underlying. So I can buy the 185 calls or the 195 calls. IV's dirt cheap. Look at this IV, super cheap. Well, I buy 1 call for $680 or 5 195 calls for $1.22. 2 days later, IBM gets a move. I make some money on both calls, but how much? Well, my 185 call, which was 75 deltas, I spent $680. Or I buy my 5 195 calls for $122. I got 145 deltas, and I spent $610. A couple days later, it's up $3. Vol's up 2 though. I made $250 on my one lot. Hey, good job. But I made $515. So we're $225 now. I made a $5.15 profit on those 5 options. That's $515. That's almost 100% return. 2 days. Spending less money. Soft deltas were way better. Real easy. So now here's some combos that I trade. So this is my favorite one. So I will follow VIX methodologies, or I'll use live vol, which I was showing you earlier. And I look for stocks hitting 52-week highs and the volatility is hitting a 52-week low at the same time. I wait a day, and then I buy the first call out of the money. Done that in Goldman. I mean, I've done that a bunch. And actually, if you have a live vol account, sorry about that. If you have a live vol account, we actually have these scans built in. Buy 45 days to expiration call. So right now, these are all stocks that I would want to own calls in. SPY, SPX, you name it. 3M. I really like 3M. Minnesota Mining and Manufacturing. Those Minnesotans. I mean, look at the July calls. The July 200 calls are going to cost me $2.66. So I get 2 full months of exposure for 2% of the cost of the stock. I like that call. All right, mark that down and keep an eye on that call. It's going to end up being worth $5 or $6, maybe more. Oh. All right, here's the other one that I like. Here's Tesla. So when IV or a VIX methodology hits a 52-week low and the stock hits a 52-week low, so we got low vol and low stock price. Buy the second put out of the money. Sinking of IVs and sinking stocks almost always mean the stock is going lower. Why do you think that is? Right, people are just selling the stock instead of hedging. Here's gold. We saw that in gold and GVZ a while back. So, in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for different positions. And know your hard versus soft delta. Here's my little offer, all right? One, just go to our website. If you go to optionpit.com, and you look at our blog, there's all sorts of stuff that we post there. I do a morning kind of update every morning that you can listen to, and I'll give you all sorts of information on what volatility is doing, what stocks are doing, and a few actionable ideas typically. You know, I'll also post webinars there that I've done, things like that. And then every now and again, I'll do a blog post. I also post trade, you know, I do a trade idea of the week that I post there. All right. Now, if you like what we do, try our option wheel program. All right. $7. All right. That's literally a cup of coffee at Starbucks. You just email me and I'll cancel it. And what we're going to do is follow trades by selling puts and then selling covered calls in stocks that I want to own. I'm going to build a portfolio, which I've done. I'm going to trade it through, creating income, and hopefully catching directional moves. All right. And you're going to be able to watch my trade management start to finish, why I pick stocks, why I don't. I do webinars every couple of weeks where you get to ask me questions and I present on something. You get email support, phone support. We're going to release a ton of education here shortly on this. All right. You go to optionpit.com/option wheel. What questions do we have? You know, yes, but I've had other ones that have been, most of my trade of the weeks have been pretty good, Paul. If you follow them. I miss out every now and again. I think historically I do pretty well. So, $7. Give the weekly wheel a try. I think you'll like it, and if you don't, it's $7, right? That's legitimately a meal at McDonald's. All right, any other questions? All right. I hope everybody had a great evening and enjoy the rest of your night and have a great day.